Hello and welcome to Quarterly Perspectives, third quarter 2020. My name is Justin Rice and I serve as a financial advisor for Personal Wealth Strategies. I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset returns, and the second part looks at recent market and economic headlines. We start our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, all major categories of stocks and bonds rose during the third quarter. Let's look a little deeper at what was driving the returns of stocks and bonds. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small capitalization companies versus large capitalization companies. History has shown that small companies tend to outperform large companies over the long term. Looking back over the past 5 years, we see that outperformance in international developed companies, but we didn't see it in U.S. and emerging market companies. Another factor of return we emphasize is value companies. Historically, value companies have outperformed growth companies over the long term. On these charts, when we see the lines going up, value outperforms growth. When they head down, growth outperforms value. Over the past 5 years, and illustrated on the graph to the left, we can see that large growth companies outperformed large value companies in every category. On the right-hand side, we look at small value companies and see that only emerging markets small value companies have done well versus small growth companies. We also see that U.S. small value and international small value companies had periods when value outperformed and periods where they didn't. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot the yield curve to show us how much interest we receive from bond investments with different maturities. The dark blue line represents interest rates at the end of 2019, and the light blue line represents interest rates at the end of the third quarter of 2020. And as we can see, interest rates remained low this quarter relative to the end of 2019. Another relevant topic to mention here is the Fed's recent decision to change the way it targets inflation from an absolute target of 2% to a historical average of 2%. This is a huge policy change that was arrived at after a year-long internal policy review in which the Fed noted that the reason behind the policy change was recent evidence showing that the relationship between the unemployment rate and inflation has shifted. Unlike previous decades, the last 10 to 15 years have demonstrated that lower levels of unemployment have not led to higher inflation. This means that future interest rates will likely remain low. In fact, the Fed has stated that it expects to keep interest rates unchanged until 2023 at minimum. We also saw yield curves steepen as investors began to demand a higher premium for holding longer-term bonds. We typically prefer investing in bonds that have shorter maturities and higher quality than the broad bond market. In the chart on the left, we see short to intermediate term bonds posted positive performance during the third quarter, and extended maturity bonds actually lost a little bit of value. In the chart on the right, lower credit qualities performed better than higher credit qualities during the quarter, but notice that the year-to-date figures still favor higher credit qualities. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. With both stock markets and bond markets advancing in the quarter, we can see that all performing asset classes contributed to the overall gain. U.S. total market stocks served as the largest contributor. Looking at year-to-date asset class returns, we see asset classes in your portfolio ranging from a positive 5.6% for U.S. large cap stocks on the high end to a negative 21.4% for U.S. real estate on the low end. Maintaining a diversified asset mix, such as a 65% stock, 35% bond mix, shown in white, kept us away from the more extreme returns from year to year, with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in our portfolios. Let's now turn our attention to some of the major stories we saw in the most recent quarter. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that may tempt us to make an investment decision we may regret. It is wise to stay informed, but we feel it very important to keep a long-term perspective when it comes to investing. When reading over these headlines, one that sticks out is U.S. stocks finish second straight quarter of big gains. This can be difficult for some to reconcile with because 2020 has been a tumultuous year to say the least. The COVID-19 pandemic and the global efforts to fight against it have affected our lives in so many ways, and as we've seen unfold over the course of the year and the previous quarter, politics and global securities markets have not been immune to COVID's effects. This year's election cycle is nearing to a close. Many wonder how that has been affecting their portfolios. Fortunately, we've seen most, if not all, asset classes regain a portion of what they lost in the first quarter, and some have even posted gains for the year as of the end of the third quarter. Big tech stocks have played a significant role in market recovery. Let's take a deeper look into how election years interact with the market and why chasing the outperformance of the technology sector might not be a great idea after all. Here we see returns both during election years and the year following, dating back to 1928. We observe both positive and negative results of small and large magnitudes. Even though this chart might resonate differently with each individual, it is difficult to reliably identify systematic return patterns related to election years. The most important thing to remember is that market expectations associated with election outcomes are embedded in security prices. Often we as investors think we can outsmart the market and can be driven by our own political preferences and biases to make costly investment decisions. It's also become commonplace to hear investors discuss market timing strategies based on their own predictions for who will win the election. To put it simply, this kind of two-step forecasting is extremely difficult to navigate. Politics aside, let's dive into one recent equity market trend for the quarter and the year. Certain sectors of industry have not only survived but thrived after the market year-to-date lows that came about in March. Technology stocks have gained even more popularity among investors and consumers alike because they have been seen as essential in living and working in a social distant economy. This has allowed the tech-heavy NASDAQ 100 index, as represented by the Invesco QQQ Trust, up 12.4% in the third quarter, to outperform the market-like S&P 500 index, as represented by the SPDR S&P 500 ETF, up 9% in the third quarter. As we can see from this chart, the technology sector has outperformed the broader market for most of the year. The gap between the two has continued to widen as the year has progressed, 31.4% versus 5.6% performance year to date. This has caused many investors to question the allocation of their own portfolios. Should we be overweighting specific sectors? Technology, perhaps? We will attempt to answer this question over the course of the next few slides. As noted earlier, the technology sector has seen a significant level of outperformance this year relative to the broad S&P 500 index. It also happens that technology companies are comprising a larger and larger portion of the S&P 500, and that has begun to influence its performance. This chart shows the performance of the S&P 500 market cap weighted, represented by the light blue line, and the S&P 500 equal weighted index, represented by the dark blue line. As the market cap weighted index begins to outperform its equal weighted counterpart, that means that the market cap index is becoming more concentrated in fewer securities, and its overall performance is relying more heavily on the performance of those securities. In effect, an investment in the S&P's market cap weighted index has become significantly less diversified. Here we attempt to quantify just how undiversified the S&P 500 has become using SPY as a proxy. which is considered a good measure of the S&P. In the chart on the left, we examine the S&P's historical weighting to its top 5 holdings over the last 15 years. As we can see, the top 5 holding concentration has hovered around its 12% average for the majority of the 15-year period. It began to deviate from that average in 2016 and really took off in 2020. And it's no surprise, the companies that currently make up the top 5 for both the S&P and the NASDAQ are identical, as the brand name tech stocks have continued to gobble up market share over the last several years. So for those who buy into either of these index ETFs seeking diversification, they might be surprised just how undiversified they really are. From a returns perspective, it gets even more interesting. SPY is up 5.6% year to date. Based off the beginning of year weights in the ETF, the estimated performance contribution of the top 5 holdings stated above is 7%. Put another way, the top 5 holdings are responsible for more than 100% of the total index gain, with Amazon leading the way with 70% return. While it might sound enticing to add an explicit allocation to the S&P, we would caution against this. First, if you own core funds, you already own all those securities, just in different weights. Second, what has happened is in the past. You can't purchase the past performance of these stocks, and we know that past performance is no guarantee of future outperformance. These big-name technology stocks are no different. In fact, the CEOs of these big tech giants are being called before Congress to testify in antitrust subcommittee hearings. Don't mistake that as a bold prediction, but rather a sign that these companies could face major regulatory issues in the future. The other thing we'd emphasize is that these stocks are incredibly expensive at the moment, historically expensive even. The valuation spread between growth and value stocks has never been wider. From a valuation perspective, the price-to-earnings ratio of the S&P 500 as of the end of the quarter was 25.9. S&P also bifurcates the index into the growth stocks and the value stocks. The price-to-earnings ratio of the S&P 500 growth was 32.9. The same ratio for the S&P 500 Value Index, which would be a better representation for the cheaper stocks in the S&P, was only 19. So investors have to ask themselves if the 73% markup they are paying per dollar of earnings is worth the bet they are taking on large, expensive technology stocks. This concludes our presentation for today. Thank you again for joining me, and make sure to tune in next quarter. To review this or past commentary, please see Personal Wealth Strategies' YouTube channel. More information can also be found on our website at www.personalwealthstrategies.com.